pay attention to what happens in California real estate inheritance over the next 6 to 12 months, because the families who didn't plan around Proposition 19 are starting to hit the wall. Properties inherited in 2021 are now fully embedded in the new tax regime. Estates that weren't restructured before the law took hold are getting reassessed. And the political pressure to repeal or revise Proposition 19 after a failed 2024 signature drive is building again. If a legislative fix or ballot initiative gains traction in 2026, the window to act under current rules is narrowing. The clock is running. If you're tired of channels softening the blow on California policy that's quietly gutting your family's financial future, hit subscribe. This channel delivers the unfiltered analysis before it hits the mainstream. Now let's get into it. Here's what you need to understand first. Proposition 19 did not arrive with sirens. It didn't come in the form of a loud, combative ballot fight that put Californians on edge. It came in wrapped in empathy, sold to voters as a lifeline for seniors displaced by wildfires, a mobility grant for disabled homeowners trapped in properties that no longer fit their lives, a compassionate update to a system that hadn't moved in decades, and it passed November 2020. 51% slim margin, consequential result, because buried inside that compassionate packaging was something else entirely. One of the most sweeping rollbacks of middle-class property tax inheritance protection that California has ever enacted. And now, more than 4 years into implementation, the financial damage is landing on real families in real zip codes, and the urgency to understand it and to act on it has never been higher. To understand what Proposition 19 actually did, you have to understand what California's property tax landscape looked like before it arrived. And that story begins in 1978, not with a politician or a governor, but with a revolt. California homeowners, particularly seniors on fixed incomes, were watching their annual property tax bills balloon in ways that had nothing to do with their income, their cash flow, or their ability to pay. The culprit was soaring assessed values. As California real estate appreciated, and it always appreciates, assessments climbed with it, and tax bills followed. Families who had owned their homes for decades were being taxed out of them, not by income loss, by success, by the rising value of the very asset they'd spent their lives building. So in 1978, California voters passed Proposition 13, and it was in the truest sense a seismic event. Proposition 13 capped the property tax rate at 1% of assessed value. It froze the assessed value at the point of purchase, and it limited annual increases to 2% or the rate of inflation, whichever was lower. Overnight, the runaway tax bill became a manageable, predictable line item. Californians who bought homes before 1978 locked in assessed values that would compound at 2% per year, forever, regardless of what the market did around them. That's the engine behind California's legendary property tax disparity. A neighbor who bought in 1982 pays a fraction of what a neighbor who bought in 2022 pays on an identical home on the same street. Proposition 13 built that gap, and for decades it was the foundation of California homeownership stability. Then came 1986, Proposition 58, and this is where the generational wealth piece clicked into place. Proposition 58 extended Proposition 13's logic into inheritance. It said, when a parent transfers property to a child, that transfer does not trigger reassessment. The child steps into the parent's assessed value, the low Proposition 13 anchored number, not the current market value. For primary residences, this protection was unlimited. For other properties, rentals, vacation homes, commercial real estate, it extended up to $1 million in assessed value. No requirement that the child live in the property, no requirement that it remain residential. A family could inherit a rental duplex in San Francisco carrying a 1985 assessed value of $150,000 and continue collecting rent while paying taxes on that ancient assessment. For decades, multiple generations, this was the mechanism. This was what critics would eventually call the loophole. And this is precisely what Proposition 19 targeted. Let's be precise about the mechanics of Proposition 19, because the details are everything. Effective February 16, 2021. The law replaced the Proposition 58 inheritance framework with something dramatically narrower. Here is what survives. One exemption, one property type, one narrow set of conditions. If a parent transfers their primary residence to a child, and that child moves into the home and claims it as their primary residence within 1 year, and files the homeowner exemption, then and only then does a partial protection apply. And even within that protected scenario, it is not unlimited. The protection covers up to $1 million above the parent's original assessed value. Everything above that threshold gets reassessed at current market value. Run that math in any coastal California market, and you quickly understand why partial protection can still mean a massive tax increase. And for every other category of property, rental homes, vacation properties, commercial buildings, undeveloped land, there is zero protection. Full stop. The moment of transfer triggers a full reassessment at current market value. The Proposition 58 shield is gone. Now let's make this tangible, because numbers on paper don't capture what this actually feels like when you're the one holding the tax bill. Picture a family in Los Altos, Silicon Valley, in one of the most expensive residential markets on the planet. The parents bought their home decades ago. Under Proposition 13, the assessed value has compounded at 2% annually and now sits at $300,000. Current market value of that home, $3.3 million. Under the old Proposition 58 framework, a child inheriting that home, even as a rental, would pay property taxes based on the $300,000 assessed value. 1% of that, $3,000 per year, manageable, generational. Under Proposition 19, if the child does not move in within 1 year, or if the home is used as a rental, that property gets reassessed to $3.3 million. 1% of $3.3 million is $33,000 per year. That is a 10 times increase. Overnight, not because the home changed, not because the family did anything wrong, because the law changed. Now project that forward, over 30 years accounting for the 2% annual cap that applies even on the reassessed value, the cumulative additional tax burden exceeds $1.3 million on that single property. $1.3 million that Proposition 58 families would never have paid. That is the financial ambush hiding inside a ballot measure voters thought was about wildfire relief. A documented case, a teacher in Los Altos who inherited a family home faced a $30,000 supplemental tax bill in the first year of inheritance. Not over the course of the year, a supplemental bill on top of whatever they were already managing. The choice for a teacher's salary becomes brutally simple. Sell the home or restructure your entire life to afford it. That is not hypothetical. That is happening right now in real California communities to real California families. Here's the macro picture that frames all of this. The California Legislative Analyst's Office estimated that Proposition 19 would generate approximately $1 to $2 billion annually in additional property tax revenue. Revenue directed to local governments, fire protection funds, and school districts. So there is a recipient on the other side of every family's increased tax bill. Money that was previously sheltered inside low-assessed inherited properties is now flowing into public coffers. Whether you view that as a correction of an unfair subsidy or as a tax on family legacy depends entirely on which side of the transaction you're standing on. And that tension between public revenue needs and private family continuity is the political fault line that Proposition 19 runs directly through. This isn't a left-right issue in the traditional sense. It's a generational asset issue. Families who built wealth through California real estate over decades are watching the rules of transfer change on them mid-game. First-generation homeowners who never accumulated that inherited assessed value advantage don't feel the same loss. But for the families in the middle, not the ultra-wealthy who can afford sophisticated trust structures, but the families who inherited a modest rental or a second property in a market that went stratospheric around them, Proposition 19 is an unambiguous financial hit. Now let's talk about what you can actually do, because understanding the problem without understanding the solutions is just anxiety on a screen. There are real strategies that exist under current law. The most powerful tool available right now is the irrevocable trust. structured, and funded before the property transfers, meaning before death. When an irrevocable trust is correctly architected by an experienced California estate attorney, it can accomplish two things simultaneously. It can shield the property from reassessment at the point of inheritance, and it can deliver a stepped-up cost basis on capital gains. That second piece is significant. If the heirs eventually choose to sell the property rather than hold it, a stepped-up basis means the capital gains calculation resets to the market value at the time of inheritance, not the original purchase price from decades ago. In a market where homes have appreciated by millions of dollars, the capital gains tax savings on a future sale can be just as significant as the property tax savings from avoiding reassessment. This is not a gray area strategy. It is legal, it is documented, and estate attorneys in high-cost California counties, Santa Clara, Marin, San Mateo, Los Angeles, are reporting sharply increased consultation volume from families racing to get structures in place before it's too late. The critical constraint: the trust must be established and the property transferred into it before the owner's death. Once death occurs, the Proposition 19 clock starts. There is no retroactive planning. There is no grace period for families who missed the window. A second strategy, less discussed but legally straightforward, applies to unmarried partners who co-own California property. Spousal transfers in California are not subject to Proposition 19's reassessment triggers. They move between spouses without reassessment. If an unmarried couple co-owns appreciated California real estate and one partner dies first, Proposition 19's rules apply to the surviving partner's inherited share in a way that spousal status would prevent. Marriage, before transfer becomes relevant, can lock in a protection that cohabitation alone cannot provide. This is not a romantic calculation, it is a financial one. And for couples who have been together for years while holding significantly appreciated California property, it is a conversation worth having with both an estate attorney and a tax advisor simultaneously. Let me also address the piece of Proposition 19 that is genuinely, unambiguously beneficial, because this channel gives you the full picture, not a selective one. For California homeowners who are 55 years of age or older, who are severely disabled, or who have been displaced by a state-declared wildfire or natural disaster, Proposition 19 actually expanded something valuable. Under the previous system and before Proposition 19, these groups could transfer their existing property tax base to a new primary residence, but only under narrow geographic conditions. Same county or one of a small number of participating counties that had opted into reciprocal agreements. Proposition 19 blew that restriction open. Now, a qualifying senior can sell their home anywhere in California, buy a replacement home anywhere in California, and carry their existing low property tax assessment with them, up to 3 times in their lifetime. That is a genuine mobility unlock. A senior in a high fire risk area of Sonoma County who wants to move to a smaller home near family in San Diego no longer has to choose between the move and their tax protection. They take the protection with them. This provision went live April 1st, 2021, and it has had a measurable, if slow-moving effect on senior migration patterns within California, particularly out of wildfire-prone rural counties and into more urban and coastal markets. It is creating supply in categories of the housing stock that had been locked up by seniors who could not afford to give up their Proposition 13 assessed values. This is a real policy benefit. It exists inside the same law that stripped inheritance protections. Both things are true simultaneously. Now let's bring this to the present moment, February 18th. 2026, and tell you exactly where things stand politically and legally. Proposition 19 has not been repealed. It has not been substantially amended. It has survived constitutional challenges in California courts with rulings upholding the law's validity. A 2024 effort to put a repeal or revision initiative on the ballot failed to gather sufficient signatures to qualify, a setback for opponents, but not a fatal one. Here's what that failed signature drive actually tells you. The opposition to Proposition 19 is real, organized, and motivated. The The Howard Jarvis Taxpayers Association, the same organization that has been the institutional backbone of Proposition 13 defense since 1978, remains active on this issue. They have the infrastructure, the donor network, and the historical credibility to mount a serious ballot initiative campaign. The 2024 attempt failed at the qualification stage. That does not mean a 2026 or 2028 attempt fails the same way, especially as the pool of directly impacted families grows year over year. Every family that inherits a California property under Proposition 19's rules and absorbs a significant tax increase becomes a potential motivated donor and petition signer for the next effort. The annual exemption adjustment is also worth tracking. The California State Board of Equalization adjusts the $1 million exemption threshold each year based on the House Price Index. For 2025, that adjusted figure came in at approximately $1,022,000. The 2026 figure will be released on the same schedule and is expected to track similarly, a modest upward adjustment that barely moves the needle on the fundamental math in high-value markets. A $1 million protection in a $3.3 million home is not the same as a $1 million protection in a $1.2 million home. The nominal adjustment helps families in lower value markets more than it helps families in the coastal markets where the pain is most acute. That asymmetry is worth naming explicitly. Here is the forward-looking picture you need to carry out of this video. The families who inherited California properties in 2021, the first year Proposition 19 was effective, are now more than 4 years into the new tax regime. They have had time to feel the real cost. Time to consult advisors, time to organize, time to become politically active. As each subsequent year adds more families to that pool of directly impacted homeowners, the political pressure for a revision or repeal grows incrementally stronger. The question is whether it grows fast enough and with sufficient funding to qualify a ballot initiative before the next major election cycle. That is the variable to watch. In terms of the real estate market, the ongoing effect of Proposition 19 is a quiet but measurable increase in pre-death property transfers and trust formations, which is keeping estate attorneys and tax advisors busier than they've been in decades. It is also accelerating some family decisions to sell appreciated properties rather than hold them for inheritance, particularly in the rental sector, which is adding a thin but real layer of inventory to coastal markets that was previously locked up behind Proposition 58 protections. This is not moving the needle on California's housing affordability crisis on its own, but it is a contributing factor that deserves acknowledgement in any honest analysis of where California housing supply is coming from. What Proposition 19 ultimately represents is a fundamental rebalancing, the state reclaiming a revenue stream that Proposition 58 had sheltered for nearly 4 decades, while simultaneously modernizing protections for seniors who needed greater geographic flexibility. It is both a tax expansion and a genuine policy improvement, depending on which provision you're evaluating. What it is not, despite how it was marketed, is a neutral technical update. It is a consequential restructuring of how generational wealth flows through California real estate. And for families who are sitting on appreciated California properties right now, watching parents age and estates grow more complex, the single most important takeaway from everything we've just walked through is this: the planning has to happen before the transfer. Before, not during probate, not after the death certificate is filed. Before. Every month that passes without a trust structure, without an estate review, without a conversation between you and a qualified California estate attorney is a month of narrowing options and growing exposure. Here is the bottom line. Proposition 19 is a structural reset of California's property tax inheritance system, one that hits hardest for families in high-value markets who didn't plan ahead, and transfers the most benefit to seniors with mobility needs and to state and local revenue streams. That is the complete, unvarnished picture. Watch the next 30 days for any legislative filings related to Proposition 19 revision in the 2026 session. Monitor the Howard Jarvis Taxpayers Association's communications for early signals of a new ballot initiative push. And if your family owns appreciated California real estate, have the trust conversation now. not next quarter. Now, if you want to stay ahead of how California policy moves money and reshapes real estate, subscribe. This is where the analysis lives before it hits the mainstream.